I want to pick up on a line that you're focused on. The difference between Fed funds and the front end of the yield curve, Fed funds in a 2-year. And that quote, how important is that?
Well, that's a signal that we're getting from the bond market. The bond market has historically been a pretty good indicator of where the Fed is relative to kind of what they need to be doing. And we saw this, by the way, on the upside too, right? In the 2021 timeframe, the 2-year got ahead on the upside. So it's the same picture, just on the other side. And you know, people complain, oh, they don't complain. They say, well, look, the stock market is behaving fine, but that's not true. Internally, once again, you know, defensive stocks are really doing extremely well. So I think the stock market is taking its cues from what the bond market is saying. It's not saying hard landing yet. What it's saying is that growth has continued to disappoint. So since April, and we've been on this program many times since then, I would say that the data has been distinguishably negative in terms of growth data. Also, the labor data has been much worse. So how has the equity market dealt with that? Well, it's pivoted from what I call quality growth to quality defensives. And we made that pivot in May. And that's classic late cycle behavior. So I think everything kind of sinks. It's just we're waiting for the, you know, like, can somebody give us the keys to the test? You know, the cliff notes, whatever it is. Like, how's this going to end? And we don't know.
But the market's, don't you? I'm going to ask you. Basically, you've said we need one of two things. Either the Fed cuts aggressively, or the labour market starts to improve and improve quickly.
That's right.
For equity markets to perform well. So have you got a base case? Is it one or the other? Do we get one or the other?
Well, what I would say is that the Fed could get ahead of the curve if they decide, but the problem, they're constrained. Okay, they're constrained by two things. Not inflation, by the way. Inflation's over, as far as I'm concerned. Inflation, they beat that. What the issue is now is the currency market. If they come in and start cutting aggressively, the yen-dollar relationship is going to create some stress. So they got to be careful with that. The other thing I would throw out there is that we've looked at this. When the Fed starts a cutting cycle with 50 basis points as opposed to 25, the chance of a soft landing goes down materially. And they know this. They know this data. They don't want to signal that. So they're in a tough spot. The Fed's in a difficult spot. They've done a good job of trying to navigate this challenging, different environment that we've been in for the last several years. But now the markets are pressing them. And so next week, I don't really care what they do next week. What I care about is how the markets react. How do the markets behave after they've done what they're going to do, 25 probably, and then what do they say in the press conference?